All right, ladies and gentlemen, good morning and good evening to everyone. Welcome to the USIBC webinar on transfer pricing, customs and GST in partnership with our member company Nexdigm. It's such a pleasure to have Maulik Doshi and Sanjay from Nexdigm join us today, who will be the speakers on the topics. And let me just give you a context on why we are doing
Put the
this.
was put into making.
Let me just give you a context on why we are doing this. So transfer pricing and GST related issues are not only issues that are faced by financial services companies, but our broader membership as well. Even if you look at semiconductor industry or other industries like electronics, they all have very similar issues, and that's one of the motivations behind doing this webinar. In fact, when Rishu reached out regarding this topic particularly, I was very happy to have them do this because they have expertise in indirect taxation and primarily based in Mumbai. I would also request Maulik and Sanjay to briefly introduce themselves before kicking in their conversation and discussion on the topics. Just to give you a background, Maulik is the Deputy Managing Director for Global Transfer Pricing and International Tax at Nextime, and Sanjay Chabria is the Director for Indirect Tax at Nextime. So over to you, gentlemen.
Thank you, Samir. Thanks a lot to everyone for joining this call. Like Samir, you mentioned, this is a very important topic, and we generally don't find this being talked about so much. And especially the interplay between the two regulations in terms of what happens under transfer pricing under direct tax and vis-a-vis GST or customs. We don't see people talking, and we had so many instances also kind of dealt with so many clients where even internally within the clients, they have been looked after by two different sets of people, two different teams, and therefore there is no convergence. And the very reason that this is not being talked about, in fact, we believe, like me, when we and Sanjay interact, we believe that the tax authorities do interact a lot more at their level on this topic rather than kind of the professions and at the industry level. So it's a very important topic, and kind of I'm glad that we are addressing this in terms of the day-to-day parts, in terms of how do you approach the two laws, the transfer pricing law and the indirect tax law, which are basically, if you ask any tax head, any multinational, which is the number one or number two worry, it would be GST and transfer pricing and GST. The chronology may vary, but this it doesn't go beyond these two to any of the tax heads. So kind of how both this law interplay and how kind of multinationals can try and navigate both these together is something we are going to discuss this today. So thank you so much again for this opportunity. Let me briefly introduce myself. My name is Maulik Doshi. I head the tax services, the direct tax services at Nexdigm. Been part and parcel of Nexdigm for last 22 years. So pretty much all my career I spent over here. I started my career as transfer pricing specialist, and over the years grew in terms of doing more other tax aspects like international tax, corporate tax, and M&A tax. So I now kind of have a overall feel of the entire direct tax law in India. I'm a chartered accountant by profession, and I'm based out of Mumbai. Before we proceed, Sanjay, quick introduction from your side, and then maybe we proceed with the presentation.
Sure. Thank you, Maulik. So I am Sanjay Chabria. I am Senior Director in Nextime. I lead the indirect tax practice. So I am also holding, around so I did my law maybe in 2006, and that's from that time I have been practicing indirect taxes. And I have exposure in global indirect taxes, Indian indirect taxes, and also, so along with being a lawyer, I have also been a chartered accountant and holding more than 23 years of at least indirect tax experience, which is till date. Have global indirect tax experience and the Indian indirect tax experience, which actually helps me at least hold on to what is happening at least in the overseas as well as what is happening in India, and maybe giving some flavor around both sides of the coin. So it actually helps in knowing that what is the taxability more, and maybe even the rates, if at all, actually it helps. So that's the costing bit, which at least I play with more, and I try and understand this further. So over to you, Maulik. I'm also looking out at this topic because it's actually going to do a larger interplay, between two international taxes, which now could have a merger somewhere, in between. While the department is already doing that, actually, we should start doing it further, at least from the company side. Over to you, Maulik. I'll just flash the screen.
Sure. That's it. So See, essentially, if any multinational that is operating globally, uh, uh, the crux is there will be so many affiliate and related parties across the globe, and to achieve efficiencies and kind of ensure that there is a proper stream of transactions that are taking place, we see a lot of related party transactions. In fact, at some point in time, there was a stat in one of the news report that of the global trade that is happening, 60% of the global trade is between affiliated parties or between related parties. So that is the quantum, or that is the enormity of the things that we are discussing. And once these multinationals operate in in kind of several jurisdictions, uh, they also kind of these related party transactions also raise questions about how to fairly allocate the profits and ensure that they are compliant with the tax regulations. This is what transfer pricing is all about, in kind of ensuring that the pricing it as arm's length. It's a framework for establishing the arm's length prices for transactions between related parties. It ensures fair reflection of the income, and both for tax as well as for commercial purposes. Now, here we have a challenge where transfer pricing is applied under the income tax law as well as by customs and GST authorities. And this is where the kind of there's a complexity or challenge that is getting created. Now, I remember, like I mentioned, that tax authorities, etc., are way ahead. I remember many years back, I think possibly once before the introduction of GST, and once again while the GST was getting introduced, that NACIN, which is the training institute for customs and indirect taxes, basically had conducted sessions on for their tax offices. And I was just looking at the agenda of that tax training session, because one of our partners was speaker there, and we were just looking at the agenda. And one of the couple of agenda items kind of really stuck me. One particular item was how to read financial statements. So essentially, they are trying to teach the GST and the customs authorities in terms of how to read a financial statement. The other was more closer to my heart, how to read a Form 3CB. A Form 3CB is a transfer pricing compliance form, a chartered accountant form, which needs to be filed every year along with your tax return. I was really surprised looking at that, saying that why on hell the customs authorities or the GST authorities need to look at Form 3CB and understand what is there in Form 3CB. And that's where I realized that they are much ahead in terms of understanding the convergence of both the laws and seeing what impact under transfer pricing and income tax has vis-a-vis the GST. So that's what we're going to kind of discuss this over the next 35-40 minutes, and then open up for question answer for people. Sanjay, we can move on to the next slide. So essentially, under transfer pricing, the transactions are defined as transactions that apply between associated enterprises. Now, obviously, under the Indian transfer pricing regulations, there are wide fictions, and there are concepts of deemed international transactions. There are concepts where deemed associated enterprises also is there. And you also have a coverage of the specified domestic transaction, which is basically your local transactions between related parties getting covered under transfer pricing. And objective under the income tax transfer pricing law is very simple, that there should not be any profit shifting out of India. So there should not be any avoidance of tax, and there should not be the tax base of India should not be affected by multinationals adopting transfer pricing in a manner that the Indian company or the Indian state gets a lower profits or lower tax. As compared to that, under indirect tax, the transfer pricing comes into picture mainly at the time of import, which is the primary the levy of the customs. And since it's a related party transaction, it will undergo a SVB valuation. So at the time of import, also the GST law that got introduced has the concept of valuation and transfer pricing for transactions between related parties. Now, the GST law is more kind of specific and deals with a particular situation. But if you look at transfer pricing under income tax and under customs, they actually work at cross purposes. Under customs, if you're purchasing goods and importing goods into India, the customs authorities want to kind of increase the value of goods so that the country gets a higher custom duty. The same, you take it to the tax officer, the income tax officer. He says your value of goods imported is very high. It should be lower so that the profitability is higher, and therefore the income tax or the corporate tax is on a higher side. So both, while deal with the concept of transfer pricing, while deal with the concept of arm's length price, both work cross purposes. And that is the balance. It's very difficult to achieve because you are trying to convince the tax of, like, you can't say that, okay, I'm importing at a price lower than arm's length, because that will affect your customs. So that balance is very important to achieve, while both try to determine the arm's length price or the transaction value. And both objectives obviously that there has to be a correct payment of tax under income tax as well as correct payment of duty under the customs act. So we need to take this into consideration that there could be cross purposes of tax authorities and customs authorities, and one needs to balance that out. We can move on, Sanjay, to the next slide. So there's there's a need for harmony between the two laws and kind of achieving that harmony. And if there's a deviation, it could lead to adverse tax consequences. And there could be various reasons for this deviation. It need not be that it's from a company's act, but the laws also are not absolutely similar, and there are kind of various differences in the law, and we are going to see what differences are there in the course of our presentation today. But for example, the definition of an associated enterprises under transfer pricing could be very different from the indirect tax laws, be it in the GST and customs. Even within customs and GST, there could be a different definition. Like under Income Tax Act, if you see the definition of related party or associated enterprises, you'll find 4 or 5 different definitions. For the purpose of transfer pricing is different. For the purpose of any different sections for applying, say, related party transaction section under 48 to be, there's a different definition. So even within income tax, there are 3 or 4 definitions. I'm sure there's a definition different under customs and GST. So the definition itself of associated enterprises or arm's length price could vary. In terms of the valuation mechanism, while under GST or customs, there is a limited guidance that is available on the valuation of related party transaction, whereas under transfer pricing, if you read Indian regulations combined with the OECD guidelines, where the Indian transfer pricing regulations are modeled on OECD guidelines. So if you combine both of them, you'll find a fair bit of guidance available, especially given that now we have 2 decades of transfer pricing being applied in India. Along with the jurisprudence, there is a fair bit of guidance available under transfer pricing. The rules of valuations are different for different classes of transactions. And that's where, again, a divergence would come into picture. That a customs would look at it, or a GST would look at it in a different manner, and the Income Tax Act would look at it in a different manner. And what we are going to do during the course of presentation, Sanjay is going to take up all such live case studies in terms of, okay, for guarantee transactions, royalty transactions, which will be the questions in everyone's mind right now. So we are going to take up all of those transactions and see how that convergence, how the divergence is there, and how the convergence can be applied for both from a transfer pricing and indirect tax perspective. And last and not least, the most important factor is that at least both the authorities have been talking. I gave you an example of how the indirect tax authorities are keen to understand what's happening under transfer pricing. They want to understand how to read a transfer pricing report or how to read a Form 3CB. So there's a lot of sharing of information between both the parties that are there. We can go on, Sanjay. So let's look at some of the differences that are there in terms of both this thing. The crux of the entire thing would come from the definition of arm's length price or open market value, and whether kind of there's a divergence or convergence there or not. So under transfer pricing, an arm's length price is defined, which is basically a price agreed in a transaction between unrelated parties. It should be comparable transaction between 2 unrelated parties, and that would be defined as the arm's length price under transfer pricing. Under GST, concept of open market value, where basically it's the same concept defined in different words, which is full value of money payable by an unrelated person. And again, there are valuation mechanisms that differ for different kinds of transactions. Now, under customs, interestingly, there is no concept or a definition of arm's length price or a fair market value or open market value. They only prescribe mechanics and methods to arrive at that pricing without prescribing any definition, etc. But in principle, we all understand that the price must be same as in a comparable transaction between 2 unrelated parties, and should not be influenced by a relationship of the group, by a parent subsidiary relationship, by a parent by kind of any other joint venture relationship. So it should be the same price as you would have agreed with a third, if you are dealing with a third party, an unrelated party. Now, the valuation methods kind of are also very important to see whether there's a convergence, divergence, what kind of interplay the valuation methods is. Now, under customs, there is under customs.
Maulik, you can speak now. Can you unmute yourself?
Yeah, so under customs, there are kind of methods that are prescribed, which is basically transaction value of identical goods and transaction value of similar goods. Now, this is similar to the comparable uncontrolled price method under transfer pricing, where you compare prices of the goods that are being sold, same or similar goods that are being sold in the transactions. So essentially, under this method, you try and compare the prices that are being applied to transactions with unrelated party and seeing whether they are comparable to the prices that are being applied when you're dealing with related parties. So the customs methods of transaction value for identical and similar goods would be similar to the cup method under transfer pricing, and which would be similar to the open market value or value of supply for goods and services of like and quality under the GST law. So to that sense, there is a convergence in terms of the kind of methods under both the laws. Under customs, there is a deductive value, which is basically by and large applied for a distributor kind of a scenario where a distributor is purchasing the goods and onward selling it, and what kind of profitability it will make before selling it, and whether that profit is similar or arm's length to the to unrelated distributor, which is very similar to the resale price method that we apply under transfer pricing. So again, there is a lot of convergence in both the methods, and there is no similar method under GST. Under customs, there is another method of computed value, which is very similar to the cost plus method, where basically for the supply of goods or services, you add on the cost from your side and apply an arm's length markup on that cost. There is a concept of value based of supply based on cost, not exactly as cost plus method, but very similar to the cost plus or the computed value method that applies under the GST. After these four methods, under customs, there is a residual method, which basically means that you would kind of apply any method, any other method to justify or determine the arm's length price or the open market value. Under transfer pricing, there is profit-based method, there is a transactional net margin method, and there is a residual other method that provides for a transfer pricing. And under GST also, there is a residual method, or there is a requirement for a valuation in specific cases. Now, one thing is very interesting to note that when you're looking at the methods under customs, there's a particular chronology that you need to apply. All of these methods are applied in a chronology. Whereas under transfer pricing, it is basically the best method rule or the most appropriate method rule. So you select the method which is most appropriate. You don't necessarily have to follow a particular chronology. So if you believe that resale price method is most appropriate, you apply that, not necessarily say that first cup should be there, I reject cup and then only reach resale price method. Whichever is the best method or the most appropriate method, you apply that. And obviously under the GST, there is the overarching principle that if the input credit is available to the recipient, then whatever value you declare on the invoices will be deemed to be the open market value. So you don't need to necessarily perform a full-fledged valuation or an arm's length pricing exercise there. So these are some of the areas in terms of the methods that are there, which kind of have convergence or divergence in terms of the valuation of the methods. There are areas of differences in terms of the transactions or the how the data is to be used. So transfer pricing has a very elaborate definition of international transactions, and there are situations where even though the transactions are not between related parties, but with a third party, which are influenced by the group company in some manner or other, then those also gets covered under the deemed international transaction. So for example, if there is a global procurement arrangement with a contract manufacturer in China, and India kind of has to import from that Chinese contract manufacturer at a particular price, so that which is being kind of driven by the global procurement team, then that transaction, although India is importing from the Chinese contract manufacturer, which is a third party, would be regarded as a deemed international transaction and would be subject to transfer pricing, would be required to be reported, etc. Now, this is not getting covered under customs or GST. But if the tax authorities see this transaction getting reported in Form 3CEB, they will naturally start thinking that, okay, if there is a control over the transaction from the from buyer and seller, then why is not be getting subject to the same requirement under the indirect tax law? So this kind of things we need to be careful. Same way, from a transfer pricing perspective, to determine the apply all of those methods, you can use the multiple year data. Now the Indian regulations are in line with OECD, where you can use the 3-year data to kind of you use the margin or the comparable uncontrolled transaction method. Whereas under indirect tax, you don't have the liberty to use the multiple year data. You have to use the data for the same period or similar period in which you are importing the goods. So you don't have to really the kind of liberty to look at the multiple year data. And one of the most important aspect is the retroactive adjustments, or what we call it true up and true down from a transfer pricing perspective. And we have a case study. We are going to discuss that in detail in terms of how it happens vis-a-vis the other transactions and what impact it has on GST and in the customs. So these are some of the areas of convergence as well as divergence as far as both the laws is concerned. I'll now ask Sanjay to take it over from here to discuss the specific issues. And like I mentioned, we are going to discuss the case studies of specific issues that multinationals kind of face on a day-to-day basis, so that it's more practical and see how it applies there. So over to you, Sanjay.
Thanks, Maulik. So while you did see the differences actually popping up and it more conceptually, we will try and see how it associates to real life examples. First live example which came to our mind was the free of cost of goods and services. So this has been the most popular transaction across board, in either inbound or outbound, and there has been an interplay which runs through the transfer pricing. So if for an example in GST case where there's an inbound transaction, for goods that would be subject to investigation, scrutiny from the special valuation branch, they will try and understand if your price that you quoted, is the right price, so that the custom duty that you are discharging is exactly, at least the same or at arm's length. When it comes to services, in the services, there is a little peculiarity, because when you're importing, the importing comes through whether there is an ITC available or whether there is no input tax credit available. So if there is an input tax credit available, you pay GST under RCM, and your declared value on invoice is anyways going to be your value, which is going to be on which you are going to pay the duty. So because it is a chain of transactions, there is no issue that the department actually looks at it, and therefore they allow you this advantage of taking it on the declared value. But if there is no input tax credit eligible, fully available, and you are maybe in the scenario as the end customer who's going to consume these services, so you pay GST on open market value. So whatever is the open market value, you will have to align and avoid any litigation. If I look at it from the transfer pricing perspective, the department says there is no dispute from the tax authorities here so far in case of free cost of goods and services. However, basically, in a scenario where they are saying is that, in case of cost plus entity, there could be an issue for the specific reason that this actually gets added to your cost base. And maybe this is going to be get repatriated, or maybe at least cost plus markup could actually come up, and therefore they can raise these issues during. And in fact, the AP authorities have also started to consider this as a notional cost when they consider the FOC element in the cost base for markup, and therefore you may want to at least look at it while it is also being reported. It is suggested that to be reported in Form 3CEB. There's one more issue which could come through is the instrumentarian ruling, which is the Kolkata Special Bench. This may trouble a lot of foreign entities. In this specifically happened that there were a lot of free cost of, there was a cost, free of cost loan which was provided to the entity, and it was mentioned that there is no base erosion, so there should not be any tax, at least transfer pricing applicability over here. But the ruling said that the foreign entity cannot get away without analyzing the Indian transfer pricing compliances. So in this, at least specifically, they said the flip side TP compliances for maybe payment made in India could be for the royalty or management fee or any of these fees that is being paid will have to be at least analyzed and reported accordingly. So there is, if you see, cleared by bifurcation between two of them, while there would be some tax liability on the other side, there could be some exemptions on the other side. When I look at the outbound transaction, GST specifically, qualifies as export if it is received in convertible for foreign exchange. It is basically for goods, and permissible limit of free supply is, subject to customs and exchange regulation. However, peculiarity exists on the services. Services specifically talks about that you should also get a convertible foreign exchange received for the services to qualify as exports. There is a condition which specifically talks about it, and therefore there are chances, and the way the law is being interpreted, that there would be GST exposure and the valuation, even if the POS is outside India, there will be GST applicable on this in this transaction, right, which is in case of outbound in services. But when we look at transfer pricing, tax authorities may dispute your free goods, or services, because basically it's a free of cost delivery which is given to you from a related party. So it actually comes under the radar of the department, as at least the AO, just to find understand if there is an issue here. So you need to report this at in your form 3CB, at least from the commercial rationale, as it is free of cost, and the documentation around it, that why exactly it is free of cost, should be at least maintained. Non-reporting on 3CB but paying GST, this could create a lot of harmony. And like Maulik did mention that the departments have been conversating in between each other, sharing data. This could lead that there is a tax liability, and maybe you is receiving some notices around this place. So if you are reporting in GST, preferred is to at least maintain some documentation around it and have some commercial rationale around this specific. Second issue is on the corporate guarantee in indirect taxes and maybe intra-group guarantee, which was specifically there. In this scenario, basically, ABC India is trying to take a loan from a third-party bank. Third-party bank says, I will not issue you this loan, unless somebody gives a guarantee. PQR, who's my related party, gives a guarantee and says, this is, I'm providing this guarantee specifically for you, and therefore you can go ahead with that. And bank discharges, gives the loan to ABC India. What happens here, and this has been developed over the period, is that transfer pricing earlier, has used to, before the ITAT ruling came in some of these cases was also 2% per annum of amount of guaranteed was considered as arm's length price in transfer pricing. But now with the ITAT ruling coming in, the 0.5% is an agreed norm, and 5.5% per annum. If this is in transfer pricing, which will now be considered as an arm's length price. But when you come to indirect taxes, this is basically the presumptive taxation or valuation that has been come through. And now it is being challenged by a lot of high courts, Delhi, Punjab, Haryana High Court, specifically, the Sterlite Power Transmission Limited, which is the benchmark first judgment, which is taking care of this. So there specifically, at least, as per the rule, they are saying it is 1% of the actual consideration, whichever is higher, will be the value on which you need to levy taxes. However, this is now being subject to the, courts to decide if 1% is valid or not. Maybe like transfer pricing, and that is the argument that we are trying to take in the indirect taxes, is that it should be at least aligned with the rules in the income taxes or the transfer pricing regulations. So maybe this could go down. However, this is 1% for the contract value. Currently, the way the law is worded, it is for the contract value and not per annum. So one bifurcation. Provision of guarantee, from an outbound perspective, which is for the PQR USA, may be considered as supply of services. However, availability of zero rating still continues. Or maybe question. If the third very, very popular question, which generally keeps getting raised, is on the intermediary services. Here, basically the overseas entity is involved in sale of software, sale of marketing, implementation, conducts a lot of researches. In some of the cases, which is the back office, XYZ Limited is providing support services. They are trying to integrate with the client's hardware and maybe also do some of the sales support, which is the out of support services. In both these cases, or both the scenarios, there might be some conversation between XYZ Indian entity which is serving directly to services to the end customer, or in some cases XYZ Inc. provides the marketing. In case of the marketing services, the sales are directly made from XYZ into the end customer. In both the scenario, transfer pricing says it is cost plus markup, plus arm's length markup, which is to be taken care of. But indirect taxes raise a lot of issues that this could actually be taxable. considering it's an intermediary service. So such supplies could be denied the benefit of zero rating and maybe considered that these are transactions within India. So there could be some challenges, at least around the transfer pricing, when we look at it from the transaction flow and the payment flow which is coming through. Fourth, very interesting scenario is the subvention scenario, wherein XYZ in case of manufacturing sell goods to India. It is the sole agent distributor which is selling things to the end customer earns a profit of 3%, while the income that they are looking at is that we should have at least a margin of 5% is what the sole limited risk distributor or the sole agent actually looks at. So there the XYZ Inc. says that okay, I will subvent that additional 2% and give that amount to you as an over and above consideration. So here in this scenario, and because he has not achieved that profit margin here in this scenario, if such transaction meets the arm's length margin, that should be at least taken care under indirect under transfer pricing. But at indirect taxes, there is no implication. There is no tax liability in case of subvention. But if I change the table a little bit and I say that okay, there is the limited risk distributor is already making that margin and making over and above margin of 7% for an example. In that case, some of these companies have termed their agreements as royalty agreements. So this royalty as a wording, specifically rings a lot of bells, and where in such cases, the agreement is so drafted that the over and above margin of 2%, which is over and above 5%, will be repatriated to XYZ. So in such cases, it indirect taxes say this could be a royalty, payment, and therefore needs to be added to the valuation. Transfer pricing has again mentioned that okay the transfer whether it is at arm's length or not, whether such royalty is being paid, because the royalty as such as a segment itself in transfer pricing is taken care of as a separate segment itself. When you say it is royalty, you will have to do a separate arm's length pricing or arm's length study, wherein if it's at arm's length or any DT deductions are equivalent is actually taken care of on this. In case of interplay between IDT and TP, when we look at the authorities, I will maybe specifically go to the questions itself. If you see, there is already a notification, MOU, which was signed between the CBDT and the CBIC to exchange the data. What happens where there is an increased value adopted by TP assessment, maybe completed 2 or 3 years, and can be considered by GST authorities for levying taxes? If the answer is, whether this can be considered for TP assessment, for an example, when the TP authorities say that, okay, this is your value, which you should have determined as, say, X, but as per GST, you were, X minus 10 or X minus 50. Would the department contest? The answer is yes. GST authorities go run behind it to understand that why was the value in direct taxes or in the transfer pricing, studies different from what is being levied in GST. And if the answer is yes, and now because it is 2 or 3 years, can somebody, at least bear the brunt, of this, or the company itself has to do that because it's an indirect taxes. I need to pass it on to someone. In this scenario, if you are able to identify your customer, then maybe you can pass that on. But in eventual scenario, when we look at today, that the brand goes to the company itself. So what we suggest here is that in case of your true down situation, the time limit to raise of your credit note to avail GST benefits in the return is 30th November for next financial year. But when there's a true up, there is no time limit to raise your debit note, so it should be routed via a debit note so that the person in front can actually take that credit and at least if they are able to claim the credit, and if there is an interest applicable to be paid on this, the existing entity who has defaulted on the value should end up paying the interest. But on the flip side, if the value of services adopted under GST is higher, whether TP authorities can adopt such value at the time of TP assessment, the time still, is this scenario is still not tested because maybe GST is far new and the officers are trying to adopt these valuation and try and question that. But when I go to the next slide, you will look at it that the customs has already triggered, the valuation of customs has already triggered such AO, scrutiny, and maybe this has gone to till the ITAT level. So maybe this could be another area where this could actually get triggered. So maybe some noteworthy rulings when we look at these rulings, I would, going to the paucity of time, I will not go a little detail into it. I will try and talk about the crux of the rulings. The crux is that, in Panasonic India, the custom valuation was higher, and the income tax officers actually said that there's a difference between your custom valuation and the valuation as per income tax chapter 10. Why is this different? And there should be a at least a parity between both, and maybe if there is a lower tax that you are actually paying, then you should actually you should take the valuation of customs rather than not taking income tax. The output that came out of the ruling was that both these laws are different, and it was held that these both laws are different. These are for different purposes. They have different criteria to be used. Hence, valuation made by custom authority should not be a guiding factor for the TPO for making adjustment on the account of ALP. This was maybe there's another contrary ruling which, and both are at par used in the coastal energy, which is on the extreme right, that talks about that where the tribunal held that the TPO action of considering the custom valuation as arm's length price for TP purpose was valid. Assessee could, because the assessee could not establish in this case that there was a differential price in other case than the customs price provided, the same was accepted and furnished to report as a contention. So this, in the coastal energy, they accepted the value, whereas in the custom valuation they rejected this. And the core area, if you look at specifically here, the differentiation is how you can explain your underlying documentation will is what is more considered when you need to prove to the your income tax authorities or the customs authorities or maybe even the GST authorities that the value that you adopted is right. If your underlying documentation does not say this, any of these rulings can actually go against you, and at least there could be some tax liability which would come through in either of these cases. Another different case which has a interplay was that in under customs the power analysis is not recognized as a parameter for comparability analysis. Thus, CUV, which may be acceptable under custom valuation rule, which may not hold good as an appropriate comparable uncontrolled price under the TP regulation. So basically, there's a different valuation. What Maulik had mentioned in the slide of valuation, if you saw that how the comparable valuation flows, while even in that, when we compare it, the department did mention that there are some parameters which are separate and not available in the GST or maybe customs, specifically, whereas they are actually available in income taxes. So there also some differentiation will have to be maintained, that how this is different from what the custom valuation has been taken care. So all these three cases do talk about a lot of interplay between these two laws, would help in at least maintaining documentation and easy for at least representing before the department. One more interesting thing, and we found this at least in a lot of domains where this that how is these practices different in US states, and this is more specifically for US IBC. So we try to bring it in this segment where is there a possibility of an agreement of authorities on the same price? Are the customs and income tax authorities looking at this? So if I look at this in India, so customs assessment is done on transaction value, whereas corporate is determined on an annual basis. So there is a differentiation. But when we look at US, the answer is yes. If an APA is sought with the involvement of custom authorities, both valuation may have an agreement. Both of these authorities may have an agreement in US. So maybe as a suggested way forward for the, in the Indian government is that involvement of custom authorities while entering into an APA could actually have a similar valuation and eradicate a lot of issues and maybe the litigation which is coming up. Maybe a noteworthy point for, advocacy, for US IPC. Do prospective TP adjustments invite scrutiny by customs authorities? Possibly. However, there is no set percentage which is there. Similar cases there in the US tax, US scenarios also. Is it recommended to conduct test and analysis under customs rules or substantiate ALP under customs rules? The answer is yes in India taxes, which we've already spoken. And it is in similar lines, which is basically in US, which says yes. And what we suggest is that a proper documentation to be maintained for whatever addition that you're making in the TP documentation. Is a TP study or an APA alone viewed by customs authorities as sufficient? In India, no, including US. However, copy of APA should be provided to customs authorities, which may help customs authorities to accept the same. Because while customs authorities determines their valuation basis the TP study reports and income tax filings that is being done, or if there is an APA that is there, there could be a request that these documents be submitted. So if you submit these documents, at least that will eradicate the issue of guessworks or maybe coming to a presumptive valuation. Existence of customs program. In India, there are none as such. However, in US, there is a reconciliation program. Original value can be reconciled within 21 months of the entry. Similar program, when I look at the time limitations, in US, the refunds must be claimed prior to liquidation or up to 21 months from the date of entry to reconciliation program, or additional duty payment could go up to 5 years from the date of entry, which is the time limit or the in event of any issue which comes up. In case of India, it is 2 years or 5 years, or for refund, it is 1 year. So timelines to be maintained accordingly. So very interesting point to look at, how these two change between two jurisdictions also. Potential conflict areas, maybe concluding on this remark, some conflict areas which could come through, on both the sides. Your valuation methodology in TP could be, raised as an alarm in the, customs or GST, or vice versa. Your true up, true down adjustment, like we discussed, may have to be looked at from your taxation perspective. Concept of deemed international transaction may be a very important here, because transfer pricing has this, indirect tax does not have it. So what will happen is that transfer pricing will report these kind of transactions. Indirect tax in GST or custom does not. So again, notice that, what are these, values which are there, and maybe having some underlying documentation around it will help you to at least represent to the department that, okay, these are valid deemed international transaction, which is as per the income tax laws. Timing difference in determination of value. If you look at indirect taxes, specifically customs, it is at the spur of that moment. Like we did discuss in the earlier slide, that the comparison is in and around the transaction. It is, at the time or around the time of that transaction itself. But in transfer pricing, it is for annually done, and the study can actually go past for some periods also, while there could be some of the years that could get covered over here. Related party transactions, like we discussed, and the free of cost was already covered. So what are the best practices that you need to start taking care? Very important thing, again, documentation, key important decisions that you've taken, have that collected at one place, harmonize with GST, whatever transfer pricing adjustments you are trying to do, or any transfer pricing study that you are trying to do, try and harmonize that with the GST and customs regulation. Do share your information during your audits, whether it is indirect tax audits or maybe transfer pricing assessments. This will help at least know that there is maybe a clear, clarity between both of your laws, and that, department doesn't see it as otherwise. Review and monitor all your adjustments and consistent transfer pricing policies entering into APS. Finally, as a way forward, do look at your valuation methodologies, disclosure alignments, exchange of information, best feasible operating model may be, taken up, and revisit all your positions frequently. Look at all your cost benefit analysis, how exactly this flows through. Related party transactions in focus, wherever there is a inclusion of two. So pricing, direct taxes, indirect taxes, do look at those from focus perspective, and have consistent documentation in all these regulations, because now the systems are talking to each other, the departments are talking to each other. The departments in the industry and at your, should also start talking more, at least at this end. So with this, before we go, if there are any questions, we will be happy to address. We had slides.
Thank you so much, Sanjay and Maulik. It's such a complicated subject to discuss, and great job condensing all that information into a few slides. Fantastic job. So, folks, if you have any questions, kindly raise your hands, and I'll invite you to ask a question. 3, 2, 1. Okay, let me just begin by asking my first question. So, what are the sort of issues that you commonly address when it comes to US companies dealing with these issues in India?
Yeah, essentially, Samir, I think some of the issues Sanjay kind of broadly mentioned as a part of the presentation. So, the free import of goods, we kind of see a lot many cases where there are import of goods and which are given as samples or sometimes as this thing. So, it poses a challenge in terms of transfer pricing both under GST as well as under the customs regulations. The other part is guarantee transaction, where again, kind of if there's a guarantee given by a US multinational for the Indian subsidiary local borrowing over from the Indian banks. From a transfer pricing perspective, even if they don't charge guarantee commission, it's okay because ultimately the Indian company is not paying. So the Indian tax authorities are least interested or they are okay with that. But there could be issues from a kind of GST perspective under the cross charge mechanism, under the reverse charge mechanism. So that's another transaction where there is there. The other transaction where we used to see a lot of controversies on mainly on the royalty transaction. Now royalty transaction, especially in a scenario where the Indian company is a distributor or kind of purchases goods for onward sale in India, and if they are making a payment of brand royalty, the tax authorities anyways look at royalty management fee as a profit extraction tool, and therefore they are anyways scrutinizing it. And customs authorities also see that whether the purchase price is subsidized by way of royalty payment, because there's a royalty payment that anyways is going, and therefore they try and enhance the value of the import of goods to the extent of royalty payment. So these are some of the kind of transactions where there are questions from tax authorities, and these are some where kind of a lot of US multinationals are facing issues, and possibly there's no end solution in line. Kind of there are litigation and court cases which have kind of resulted into favor of the taxpayer. But yes, still some litigation will continue for some time.
Thank you, Maulik, for that response. Anyone else has any questions? Please raise your hand. Going once, twice, thrice. If not, I have another question to ask you. So, what are the sort of recommendations that you have made to the government previously regarding these topics, if any, or are issues similar in nature when you deal also with the state governments? That perspective also will help a lot of our members.
So Sanjay, you want to take it up, especially
Yeah, yeah.
representations on the GST side, because
Yeah.
customs transfer pricing have been age old and no current representations are filed. And some of the customs and transfer pricing fight is not only India specific, it's globally. So you go to any European country, you go to US, etc. Everywhere the same issue is there. So, but yeah, GST is something where Sachin can shed more light on that.
So like I did mention, I think a lot of customs representations and GST representation have undergone. In fact, one of the representation that which I specifically highlighted for you, somebody to pick up was that involvement of customs authorities in APA. You know, that could actually ease out a lot of stuff where the customs authority itself is watching that, okay, this transaction valuation is at least as arm's length. So that's specifically there. While customs is a very old law, GST is evolving. GST on the state level is again, very they go more theoretical. So issues would be raised at their end. So maintaining more documentation, having that clarity on what kind of rates that we are taking care could help at least at the GST level. Customs in or around, the issue is that it stops your business. The moment you import something and they challenge your value, you have to take that call at the spur of the moment that do you pay that or not. So that's where the EDD valuation comes in, and they continue with the special valuation branch verification, and then clear off your arm's length pricing on the value of the goods. So that way at least this is a fair, more clearer law, but the GST is still evolving. I think there is a lot more to advocate over there, at least from our end.
Absolutely. Thank you so much for that response. Folks, any other questions? If not, I actually have another question to pose. So, do you think GST, customs, and things like that have to be rationalized sector-wise in order to like have a more focused approach and make ease of doing business? I mean, bring in ease of doing business in India. So let's say there are semiconductor manufacturers or folks who are like dealing with bringing hardware into India, IT hardware specifically. So do you think that sort of an approach is going to help business?
So, pretty generic as a answer. And if I look at excise regime was more manufacturing based, focused. Service, when you look at VO, it was more IT, ITES, or the sectors around the service industry as a focus. And VAT was more from trading perspective. So this merging actually did happen just to bring in the input tax credit exchange, which was to be happening around it as a credit pool was larger and could be utilized. While if you see the law, earlier law which have been merged into this are somewhere bifurcated in the law itself, but what you are maybe referring to from the valuation perspective, it is a clarity around this would help further, at least on the sector-based analysis.
Understood. Thank you so much, Sanjay, for that response. Folks, any other questions? Otherwise, thank you so much for everyone for joining us. Special thanks to our speakers and partner Nexdigm, Sanjay and Maulik. Thank you very much for those presentations and immensely thank and grateful to Rishu for facilitating this conversation. We'll shortly upload this video to our YouTube channel and also publish it in our social media. And look forward to having you guys over and join us and discuss topics like this of interest to our members going forward as well. Have a nice evening and have a good day for those folks in the
Thank you
US.
so much.
Take care.
Thanks, sir.
Thank you.
Thank-
Bye.
Thank you, guys.